Hi, Mary. Nice to see you guys again. Um, I'd like to talk to you today about the tax section within your financial plan. There's several areas that I'd like to address today. There's a couple things that don't have to be addressed until much later in time, but we'll go through each and every one of my recommendations as well as the tax consequences of those recommendations. And then if you have any questions, we can address those at this time, or if you want, you can give me a call next week and we can set up another meeting, whatever works for you. So the first thing I'd like to address is your current tax returns. I had identified several errors or mistakes within your 2017 1040. Two of the major ones being the 401k and the 403b contributions were not being deducted from your gross income. Therefore, you're actually paying more taxes than what you should. Also, there's a couple of tax credits, child tax credit, and some other credits that were slightly incorrect. Bottom line is we were able to get you a $675 tax credit for 2018. And we went ahead and reflected that on your 2018 and also your taxes for your 2019 cash flow statements. The second thing I'd like to talk to you about, well, actually, another note with regard to your 1040 returns. Because we're not like a tax agency, I'm not a CPA, not a tax attorney, etc. I think that it would be best for you guys to go ahead and take your past 3 or 4 years worth of tax returns to a tax professional, whether it be a CPA or tax attorney, to go ahead and get those things looked over to ensure that you're not eligible for any additional tax credits. And then from here on forward, also addressing a tax professional to go ahead and get everything laid out correctly and make sure that you're paying the appropriate tax. Also with that, when we talk about the ranch property later, I think at that point, because of substantial increases of income and having to deal with the ranch property itself, seeing a tax professional or attorney would also be a good idea. The second thing I'd like to talk to you about today is your homestead exemption. I'm not sure. I didn't have any information that you did or did not file your homestead exemption with the County of Lubbock. What this will allow you to do is cap basically your property tax percentage. So let's say you're paying 2% property tax. Now it would cap the ability of the county or city increasing that 2% by 10% each year. So it'd be 2.2%, 2.42%, etc. But it basically limits the increases that they can impose upon you, not your home value, but rather the actual property tax itself. Also, by filing your homestead exemption with your current home, this will allow you to not have to claim upwards of $500,000 on the sale of your home. So I know we're talking about making some upgrades to your home in the next 10 years and looking to sell the home by 2030. This will allow you to go ahead and then use whatever you actually paid for your house, $125,000. So if you were to get, let's say, $625,000 for your home, you wouldn't have to pay in long-term capital gains on that incurred income. The third thing I'd like to talk to you about is right now, or actually in the past, you've been able to go ahead and deduct your charitable deductions, and with your property tax that you pay as well as your mortgage interest that you pay, you can add that to the $11,000 that you've been giving to charity every year, and that's a greater amount than your standard deduction, and therefore you can go ahead and deduct more money from your gross income and allows you to pay less in taxes at the end of the year. We're going to use a bucket approach and essentially go ahead and put your 10% of your total gross income into a traditional IRA, and then every other year go ahead and pull from that traditional IRA, because John, you'll be over 59 and a half, so we won't get any penalties, and go ahead and move that money directly into a donor advised fund. And I know we talked about that previously. I know we're on a tight schedule for time, so there's one other thing I'd like to talk to you about. That is the creation of your family limited partnership and funding the family limited partnership with your ranch asset, and you, John and Mary, having the primary general management interest, and then gifting some interest of that ranch to both Lizzie and Michael. By doing this, it'll be the property in 2028, when you'll receive possession, is going to be roughly worth $2.28 million, and it was transferred at your mother's death at $1.7 million. So that would incur a taxable event. However, by creating the FLP and transferring interest to Michael and Lizzie, we will be able to reduce that to roughly right around the $1.7 million for basis, and then at that point we don't have to have a taxable event. But upon these gifts, this interest to both Michael and Lizzie, I do want to remind you that because you're gifting, and it'll be likely much more than the annual gift exemption, which currently is $15,000, you'll have to go ahead and fill out a gift tax return, and like I said earlier, you seeing a tax professional and attorney at that point in time will allow these things to work smoothly. Okay, thank you very much, and have a great day, and we'll talk to you soon.